Thank you, Solveig, for opening the session today. Let me welcome you all to this webinar that we're holding on the occasion of the publication of our two latest annual statistical reports on derivatives and securities markets. It's a great pleasure to have you with us. I am Steffen Kern. I lead the analytical operations at ESMA, and it's my pleasure, together with my colleagues, in particular Christian Winkler, who is the head of our markets analysis team, as well as Caroline and Damien, who will be sharing with you the two reports that we're publishing and who actually coordinated and led the projects of these two reports, together with these colleagues, to welcome you and have you with us today. Let me say right away that for us, this is an opportunity to share with you the work that we've been doing in this space and to explain the background of what we're showing. But it's also an opportunity for us to hear from you what you think about our documents, what you think about our analysis and the statistics that we produce. And since all of these annual statistical reports are today and will remain for a long time a work in progress, an exercise in continuously enhancing the coverage, the quality of the data, and also our analysis. Since this is a work in progress, we are very much looking forward to any comments that you may have, any remarks that you may share with us, and also any questions that you may pose to us. We will be looking forward to and trying to answer them, or at least give you considerations from our side that has led to that have led us to the analysis that we produced and the data that we share. That as a general remark for the opening of this session, let me at this point highlight the importance of the work we're looking at today. I just came out of a public conference by the European Commission on a totally unrelated subject, on the forthcoming review of the Alternative Investors Management Directive, AFMD. And the Commissioner for the Single Market in this context held an opening speech, and she underlined once again the immense importance of market transparency and also public transparency around the regulatory and supervisory tasks that we are undertaking. She underlined how important it is to share with markets and with the wider public what we're doing and how we're doing it. And I think on that note, it is just important to understand that, for example, publications like the ones we're looking at today are a centerpiece of our work in order to provide transparency around data whose collection is an enormous effort for market participants, for national authorities, and for ourselves. And also data where in quite some granularity and in very high volumes, we can have the derivatives and in the securities world up to a level that maybe many other jurisdictions around the world cannot. So we are at a great advantage and great privilege to have access to these data and be able to use them. From that perspective, I'm very, very glad that we can discuss with you today and present to you today the two annual statistical reports. The first one on derivatives, of course, many of you may know that is already a routine. It's a long-standing item. If I'm not mistaken, it's the third time that we produce this report on the EU derivatives markets and based on EMIR data. It is certainly, when it comes to the data, one of the most complicated exercises that we're undertaking, but we do show a very, very solid overview of the market in the European Union, a 680 trillion euro gross notional outstanding market in this space, which is developing in very important ways and which takes a very important position in the financial system of the European Union. And the second report, quite in contrast, so to say, is all new. It is our immense pleasure to share with you for the first time securities market data drawing from the MiFID data system. So from a legislative framework that has been all discussed many, many times in the past years and is looked at with major interest from all sides. Here we, for the first time, provide an overview of the market, but also some measures, statistics and metrics about the securities trading system in the European Union for the first time, and again at a level of granularity that elsewhere in the world oftentimes cannot be achieved. So this is very important to us, and we are very, very glad to be able to share that with you. Now, before I hand it over to my colleagues who have worked a lot and very intensively in the past years to bring about these reports, I would like to make two caveats. First of all, no policy. I'm afraid we are all aware of the fact that in particular these days, both in the derivatives world and in the securities trading worlds, we have a number of very important policy issues to be discussed and decisions to be taken. Now, we have the privilege today to look at the data and the statistics. If you have policy-related questions or remarks, of course, we will be glad to hear them. And of course, we will be glad to take them back to our organization, to ESMA, discuss them with our policy colleagues, and try and get you in touch or get you an answer on these questions. But at this meeting today, we will not be in a position to give you detailed policy responses in this matter. And I very much trust that you understand this very well. The second point is about data quality. I mentioned it already. Data quality remains one of the centerpieces of our work in actually trying to develop the data systems that we have, no matter whether it is EMIR or MiFID material that we're looking at. And data quality remains an issue for us today, many, many years, because quality is not only an ongoing and an eternal work, it is particularly so in the case of EMIR and MiFID, two very complex data systems which pose a lot of demands on market participants who are submitting the data, but also on us and our friends in national authorities who need to bring them together, clean them up, and make them usable. Now, this, of course, comes with all sorts of difficulties, so please, and I'm asking you right away in very general terms, for your understanding that our reports have, for example, data cutoff deadlines. So everything that has developed in these data systems, all the progress that has been made on improving the quality after these data cutoff dates, we cannot reflect in these reports. And this is particularly pertinent in the securities markets world these days. If you look at the material we present on systematic internalizers and bond markets in this area, since the cutoff date for the publication, a lot has been achieved, further achieved on data quality improvements. And these improvements, unfortunately, cannot be reflected in today's statistics. This is not, game-changing material, of course. These will, in most cases, only be nuances, but please be aware that these progresses are being made. And with that, I also ask all of you who may be here on the call, whose organizations contributed to this exercise, not to be disappointed if some progress that has been made in the past months in terms of data quality is not yet reflected in this report. It will be reflected in next iterations and next reportings that we do, but for the moment, this is what we can show. And on systematic internalizers and bonds, by the way, we will clarify this point again in an additional footnote that we will insert in the document, just to make sure that everybody who reads this document fully understands the difference in the data between the reporting dates back then of February 2020 and everything that happened thereafter. So I ask you for your understanding on this. This does not mar the quality of the data that we present. It is a fact that we need to take into consideration always when looking at statistics. It's all about when did you measure. And in this case, the cutoff dates are clarified in the document. So thank you very much for that understanding right away. And with these introductory remarks, I am very pleased to hand it over to Christian Winkler, who heads the market analysis team and who will guide you through the discussion. And who will be, of course, himself, together with all the other colleagues on the topics, we will be very pleased to answer your questions and to provide any explanations that you might want to have. Thank you very much. Thank you for your attention, and I hope this is going to be an interesting event. With that, over to Christian. Thank you.
Many thanks, Steffen, and a big welcome also from my side to all of you who are joining us today. And I will basically not make any further remarks. Solveig has already set out the ground rules also for discussion later. And we'll hand over to Caroline Lemoine, who will present us with the key results of our MiFID annual statistical report, so the report covering EU securities markets from an equity and bond perspective. Caroline, the floor is yours.
Hello. Sorry. Yes, I hope that you can hear me clearly and that you can see the slides. Thank you very much for the introduction, also for putting things in perspective. I'm glad to be presenting today the first, indeed, EU securities market annual statistical report. And I'm also glad that I see that we already have questions on this report, so I will happily try to answer them as much as possible. As an introduction to this report and also to continue in this perspective, first of all, I want to thank all the colleagues that have worked on this report and obviously all the counterparties, but also NCAs that have worked during the past months/years to produce this to help us produce this analysis. This first annual report relies on sources linked to MiFID II regulation, and it's a continuation of previous and other ESMA risk analysis, such as the Trends, Risk and Vulnerability report that is published twice a year, the risk dashboard, and other annual statistical reports. This report is helping us, as Stefan was saying, it's helping us identify quality issues and improve the methodology that we use. That's also something that we present in the report itself. And it is a very important tool to give us a high-level mapping of EU securities markets. This report looks at 2019. On two asset classes. This first report, equity and bond instruments. Obviously, we tried to take into account recent market events. So you will find in the report a COVID-19 box that is presenting the recent turmoils in the securities markets. Also in the report, you will find two articles. One, as I was saying, presenting the different methodologies that we create and the data quality issues that we encounter to create those indicators. The second article is presenting all the transparency calculation data and try to also give an overview of the characteristics of the instruments that are deemed as liquid. So let me go into the main results of the report. Obviously, it will be difficult to squeeze everything in this presentation, but I will just try to give you the main messages and the most important analysis features that are in the report. But obviously, I think a lot of material can be found in the report itself. So, in terms of the overview, we are presenting the whole European markets. One of the interesting features that is important is the fact that we see that there are a lot of trading venues in Europe. That is also a sign that we have a fragmentation of trading. We will get into that in a few minutes. But first, the venues. We have more than 430 trading venues, so regulated market, multilateral trading facilities, organized trading facilities, and on top of that, we also have more than 200 systematic internalizers in 2019. What we observe is that the venues that were, the growth that we saw in the number of venues were mostly coming from MTFs and SI in 2019. Then for the volumes, we have more than 27 trillion euros of trading volumes in equity market, most of it being in share trading, and 101 trillion volumes in the bond market. 3/4 of which being in the sovereign bond trading volumes. For the other messages, I'll get into details in the next few slides, but before getting into this, I also wanted to give you an overview of the essential statistics that are presented in the report. This table is also helping us make sense of the most important type of venues, countries, issuers, for the asset classes that we cover in this report. So as you see in this table of statistics, again, it's in the report, and I will maybe not get into all the details here, but it's helping us make sense of what is happening on exchange, off exchange, and also looking at the difference between issuers. For instance, we also have a look in the report at international activity, looking at what are the characteristics of non-EEA issuers, so European issuers coming from the European Economic Area. We also present the most important number in terms of the transparency calculations. So, to give you a hint of the market overview, as I was saying, there's the main point for the European securities market is that we see there's a lot of trading venues, but there's also a large number of available instruments. What we've observed is that there's 28,000 equity and equity-light instruments that are available for trading, and more than 170,000 bonds available for trading. So this discrepancy between equity and bonds first can tell us that there's a higher number of bonds that are available for trading, maybe also because these instruments are less standardized. And also this difference is helping us maybe make sense of the different trading patterns that we observe in the next few slides. So first of all, beginning with the equity market, what we observe in terms of trading volumes is that equity trading is close to evenly traded across all the market types. So be it on regulated market, multilateral trading facility, systematic internalizers, and also over the counter. So close to on and off exchange volume being even. On exchange trading is mostly concentrated on UK venues in 2019. Looking only at shares now, what we observe is that when we look at, for instance, the indicators of the capitalization, the market cap of those issuers, we observe that there's a concentration in terms of issuer domicile. The most important market capitalization are observed in the UK, in Germany, and in France. It's also the case for volumes. For instance, we have an interesting analysis of the type of companies. We look at the trading volumes of by type of companies, looking at the large and very large companies, looking at company size, maybe to be clearer. What we observe is that the vast majority of trading volumes is on shares of large and very large companies, while SMEs, so small and medium-sized enterprises, make up only less than 1% basically of the trading volumes. We also have a look at exchange-traded funds. What we observe is that we observe a growth in trading, first in trading volumes of ETFs, but also in the number of instruments. So first in trading volume, what you observe is that ETFs made up only 6% of equity instruments trading volumes in 2019. In 2019, it's 10%. We observed also that the largest issuers of ETFs in Europe are Luxembourg and Ireland, but they are not that much traded on venues from those countries. Now, going to the bond market, if I can change the slide. Okay, sorry. Okay, it's working now. If I'm going now to the bond market. So first, when we look at bond market, the interesting feature that I was saying before was we observe a large number of instruments. What we wanted also to look at was who were who were the biggest issuers. So, for instance, if we look at the nominal amount, so basically the nominal amount outstanding, which will be the amount that will be repaid to bondholders at maturity, we observe that even though sovereign bonds make up only 5% of the available bond instruments, they make up 44% of the nominal amount outstanding. So it's close to a number that we observe for corporate bonds as well. And the highest nominal amounts were observed in Germany and in the UK. Looking at all the countries, the graph that you see on the left, you can observe that the corporate share, so the share of nominal amount by issuers for corporates is higher in the Netherlands, in the UK, in Spain, while we see that it's more bonds share that is higher in Italy and Belgium. Also, the interesting feature that we observe when we look at Luxembourg, for instance, is that the other bonds make up the highest share of the nominal amount outstanding in Luxembourg. And it's mostly linked to the fact that they have more supranational issuers that are classified in the other bonds. Looking at bond trading volumes, and maybe on the contrary with equity markets, we observe that the vast majority of bond trading is happening off exchange, with 50% over the counter and 26% of trading volumes on systematic internalizers. This is more true. We observe more over-the-counter trading for corporate bonds than for sovereign bonds. What we also observe is that the trading volumes on regulated market is very small, with 1% of the volumes. The other on-exchange volume happening on MTFs or on organized trading facilities. On-exchange trading is also highly concentrated in the UK, with 80% of the volumes. Finally, you will find also in the report some indicators to try to appreciate what is the liquidity of those bonds. So, for instance, we try to analyze the number of bonds that are traded at least once a month, once a day, and we observe that only 17% of bonds, for instance, of corporate bonds, for instance, are traded at least once a month. To give you the flavor also of the MiFID transparency calculation analysis that are presented in the report, I will give you a hint of the characteristics of the instruments, the equity and bond instruments that are deemed as liquid under MiFID II regulation. So what we observe is, for instance, for equities, is that we have a little bit more than 2,000 instruments that were considered as liquid in 2019. It's more than in 2018. This growth is mostly driven by ETFs, but all in all, those 2,000 instruments make up 7% of all available equities. And also, as you see in the graph on the left-hand side, those instruments are largely coming from big companies, large and medium and large issuers, and we observe that only 3 liquid instruments were coming from small and medium enterprises. Looking at the domiciles of those shares deemed as liquid, most of the issuers are domiciled in the UK, in Germany, and in Sweden. And you will also find in the report the comparison between the number of shares that are issued in those countries and the number of shares that are deemed as liquid from those countries. Looking at bonds, finally, at the end of 2019, we have close to 600 bond instruments that are considered as liquid, a number that has more than tripled since 2018. However, these numbers only represent 0.3% of all available bonds. Those liquid bonds are mostly coming from sovereign issuers, so mostly sovereign bonds, representing 61%, and corporate bonds are close to 20%. The nominal amount of those liquid bonds issued in the EEA represent 8 trillion euros, and sovereign make up most of it, so 98%. So that's it for the first glimpse of the main messages of the report. You will find much more indicators and explanation in the report, and I will be glad to answer any question that you may have.
Thanks, Caroline. In terms of questions, I would suggest that we bundle them all and have a joint discussion session for both annual statistical reports at the end. And in that spirit, I would hand over to my colleague Damien Fennell, who will guide you through the main results of the derivatives markets annual statistical report based on EMEA data. Damien, the floor is yours.
Thank you, Christian. So I just want to check, can everyone see the slides of the derivatives report?
Yes.
Okay.
They are up. And we can
Thank you, Christian. So thanks everyone for joining and joining this session. So I'm going to talk through, in a high-level overview fashion, the results of the third annual derivatives statistical report, which we published about 10 days ago, I think now. As this is a more established annual statistical report, I will jump a bit more quickly into the results, but I do also want to kind of echo what Caroline said, which is thank you very much to colleagues who've worked on this, and also NCAs and colleagues in ESMA for their feedback, and very much welcome your thoughts on this in the questions. So the main results, so in terms of the derivatives report, is the market size has shrunk. So in terms of market sizing for the annual statistical report in derivatives, the main metric we use is the total notional amount outstanding. And in these terms, the market has shrunk in 2019 relative to 2018. So the reporting period for this report is the 2019 calendar year. And what we've seen over 2018 is a fall in all assets except interest rate derivatives, and the drop is largely driven by currencies and equities. Another key finding of this year's report is the increase in central clearing rates, and this is visible both in the two asset classes where we have central clearing required by the clearing obligation. This is interest rate derivatives, where the total outstanding, which is cleared relative to the overall outstanding notional, increases from 63% at the end of 2018 to 69% at the end of 2019, and the corresponding change for credit is from 25% to 32%, so quite a big increases. Just an observation that the low relative clearing rates, for instance, for credit is really driven by the fact that this is for all credit derivatives outstanding, and quite a few of those are not subject to the clearing obligation. In terms of trading venue activity, things like the split between exchange traded derivatives and over-the-counter derivatives, we see that over 2019 there was a slight decrease in exchange traded derivative notional amount share from 10% in 2018 to 8%. Whilst over-the-counter obviously grew correspondingly to 92%, but we did see a small increase nonetheless in over-the-counter activity on trading venues, and I'll talk a bit more about that shortly. In terms of concentration interconnectedness, unsurprisingly, we don't see much change. We see continuing high counterparty concentration. So you have, across all the asset classes, you tend to have counterparties with large exposures, a few counterparties with large exposures, and a large number of smaller counterparties with very small exposures. And you have quite significant interconnectedness in the sense that you tend to have large counterparties connected to very, very many smaller counterparties, and obviously connected with each other. In terms of geographic concentration, again, it shouldn't be surprising, but the UK remains the dominant market in 2019 with little change from 2018. In fact, I think the overall share of exposures that have a UK, at least one UK domiciled counterparty, remained at, I think, 82% of total notional amount. There were signs, some signs of change, though, not very strong, but slight change with UK to US exposures growing slightly, with UK to EEA exposures falling again slightly. So they're the main results. So kind of just to kind of flag changes this year in terms of statistics and approach. There's not much to say here, but there are a few things worth mentioning. As I said, the focus is on 2019. As in previous reports, we use quarterly trade state data. So we're not looking at the trade activity data yet in EMEA. This is on our list of things we would like to eventually do. But as Stefan said at the beginning, we're taking an incremental approach, and we're moving forward on that basis. We've also included, like in the MIFID report, we've also included a COVID-19 box, which has a brief discussion of some of the impacts we saw earlier this year, even though this is strictly speaking outside the reporting period for the report. We've had a few data improvements this year, which is positive, and I think has improved the analysis. So one thing we've done this year is we've included in the time series, we've also included 2018. Partly because we can, because in the previous report we had regulatory technical standards in 2017, which introduced a structural break, which meant that we were reluctant to mix the two different time periods for fear that would be misleading. So this year we haven't had that situation, so we've been able to extend the time series to include 2018. And we've also had an improvement in the 2018 data, which was largely due to the removal of a counterparty that had been, the data from a counterparty that had been over-reporting quite significantly. So we've removed that data, and that's actually improved, I think, some of the findings. And one example of that is we now see a fall in the notional amounts of contracts for difference around the time of the product intervention rules in 2018. Just briefly mention the statistical articles that we have at the end of the report. We have, as per usual, we have an article on statistical methods, and in this case, it talks a bit about the cleaning of the over-reporting that I just mentioned. We also have two articles on particular topics. We have one on credit default swaps, and then a second one looking at central counterparty margins, which is itself an innovation because we're looking at margins data, so we're moving beyond the focus on notional amounts and numbers of trades that we've had thus far. So I'll quickly go through this. I'm conscious of time, so I'll go through this quite quickly, and I won't cover everything that's in the report because, as you can imagine, there's a lot more than I'm going to be able to present. But quickly discuss a bit on the market size and structure. So as Stefan mentioned, the size of the market in terms of total notional amount is 681 trillion. And this is a 5% decrease on the year before, mainly due to falls in currencies and equities. Associated with that notional amount are 50 million outstanding contracts or transactions, as we put it, and that's down very slightly as well, I think. No, sorry, that's up slightly, I think, from 49 million the year before, but essentially unchanged. We've seen falls in most assets in terms of notional amounts, but interest rate derivatives is flat. The big falls are in equity, where we saw a 35% fall, currency a 15% fall, credit 7%, and commodities 37%. So yes, that gives you a sense of what's driving the shrinkage in the market. In terms of the structure, the split, the distribution of asset classes across the markets, interest rate derivatives continue to dominate, as you'd expect, at 82% of overall notional amount, and currencies now at 11%. If we look at products, we can see that swaps account for 62%, forward rate agreements 11%, forwards 9%, and options 8%. And then obviously the rest by the other smaller products. And in terms of number of transactions, equities and currency account for by far the largest number of transactions, followed by interest rates. And in terms of products, we see contracts for difference still account for by far the most number of contracts, followed by swaps, forwards, options, and futures. And in terms of intergroup transactions, we see that I think about 16% of the total notional amount and 12% of transactions is accounted for by exposures between two different entities in the same group. Within this, we see quite significant EEA to UK and UK to US links within the same groups. Here, just briefly have a summary of the different asset classes so you can see the trends here. So for instance, if we look at equities, you can see that the fall between 2018 and 2019 on the bottom left is driven largely by falls in equity options and so on. I won't dwell too much on this to give us time for questions. In terms of the number, looking quickly at the number of transactions and the trends here, we can see that in terms of number of trades, most assets were down. In contrast, the number of equity transactions was strongly up. So essentially, what was driving this is a large increase in the number of equity contracts for difference through 2019. So that's obviously something we want to monitor going forward. But that's essentially what's driven the change in equity CFDs. Okay, so now I'll talk a bit more on exchange and off exchange trading of derivatives. So as I mentioned earlier, we had a fall in 2019 in exchange traded derivatives from 10% to 8% and corresponding growth in over the counter. But we did see nonetheless within the OTC an increase of the proportion that was traded on trading venues. So this is multilateral trading facilities or organized trading facilities. And here we can see that at the end of 2019, over-the-counter derivatives accounted for a total of 7% of the overall notional amount, which was up 1 percentage point from the year before. And as I mentioned before, ETD was down by 2 percentage points. And this was driven by falls in the overall amounts of products that tend to be exchange traded. So for instance, we see falls in the overall proportions of equity futures, interest rate futures, and equity options. So I think what's driving this is more a shrinkage in the share of products that are exchange traded rather than a shift within certain products from exchange traded to over the counter. So to go into a bit more detail, about 2/3 of the 30 trillion notional amount fall in exchange traded derivatives was about 2/3 of that was from interest rate, a fall in the overall notional amount of interest rate futures, and about 1/3 from equity futures and equity options. And then the increase that we've seen on over the counter on trading venue arose from currencies and interest rate derivatives. Central clearing. So this is one of the main findings of the report, that we saw this quite marked increase in central clearing for both interest rate derivatives and credit. We also saw it for commodities as well. So as I mentioned earlier, you can see the increases here of from 63 to 69% for interest rate derivatives and from 25% to 32% for credit. Underlying this, in the interest rate derivative case, was an increase in clearing mainly by EU-based CCPs, and here the share cleared grew in the EU to up to 63%, which was up 5 percentage points from the year before. In contrast, for credit, the share cleared by EU-based CCPs actually fell slightly by 1 percentage point, down to 12%, whilst that for third countries grew quite significantly, as you'd expect, since the overall clearing increased to 19%, which was up 7 percentage points. In the bottom bit of this slide, what we look at is specific products subject to the clearing obligation, and we look at the clearing rates for these, just to flag a difference in the metric here. So these are clearing rates for recent trades, rather than the overall cleared notional amount for all outstanding trades, which is the previous metric. So looking at the kind of clearing rate of recent trades, we see for interest rate derivatives in the G4 currencies, this has increased to 89%, which is up 9 percentage points. That for Norwegian kroner, zloty, and Swedish kroner was up to 91%, which was up 8 percentage points. Whilst for credit, the CPS on European indices grew 1 percentage point to 46%. So that gives you a sense of the more recent changes, the kind of flow, if I could put it like that, in terms of clearing that we saw in 2019. So here I'll pick up briefly on the kind of counterparty and the geographic concentration. So in terms of where the exposures are and who's exposed to whom, we haven't seen really kind of marked changes from the year before. The broad patterns remain the same, which is again what you'd expect. You wouldn't expect the market to change very dramatically. So here we see that central clearing counterparties account for just over 1/3 of the overall notional, and obviously mainly in interest rate derivatives and credit, which is as you'd expect, since these are the asset classes that contain products that are subject to the clearing obligation. Investment firms have a very large presence, again around 1/3 across all asset classes. Banks also have a significant presence at about 20% overall, but they're less present in commodities. Non-financials stand at around 5%, and again, intuitively, they're quite significant within commodities. In terms of concentration, we do see quite high concentration across all asset classes. So, for instance, if we take the top 5 counterparties, their exposures, they account for above 40% across all asset classes of the total notional amount, and it's even higher in interest rate derivatives, where it goes to 60% plus, and this is driven by the CCPs. And of course, there are strong linkages between counterparties, particularly between central clearing counterparties, investment firms, and banks, which again is as you would expect. If we look briefly at the geographical distribution, we see that as in 2018, I think it's 82% of the total notional amount involves at least one UK counterparty. And we see this across asset classes. The UK is at the core of the market. We have large UK to France, UK to Germany, UK to UK, and UK to US exposures in all assets in 2019. We do see a slight fall in the exposures between the UK and the EEA, I think with the exception of commodities. But it does seem to hold across the other asset classes. We give more precise details in the report on that. So I'm going to just very quickly finish with a mention on the 2 articles that we have at the end of the report, which cover more specific topics in a bit more detail. So the first article is on credit default swaps, and here essentially we do a little mini deep dive into one of the specific products, and in particular the product that drives, which accounts for most credit derivatives. So for credit default swaps, we find that the total notional amount at the end of 2019 was about 10 trillion euros, which accounts for 85% of all credit derivatives, and it grew from the first to the third quarter before falling in the fourth quarter. The denomination is mainly euros and dollars, and again, very highly concentrated in this case. Here we have top 5 hold over half. I think CDS are the most concentrated after interest rate derivatives. Excuse me, and banks and investment firms hold about 90%. So really quite strong concentration in this case. We have about an equal split between multi-name and single-name credit default swaps, with the multi-name share continuing to grow. It's been growing persistently over recent years. And credit default swaps, I think, which refer to non-financials, account for about half of single-name CDS notionals. So you can see here quite a strong link with the real economy in terms of the link through this particular derivative product. So there's that short article looking at credit default swaps, and then the second article looks at initial margins and excess collateral for CCPs. And here we see that at the end of 2019 there was just under 400 billion outstanding additional margin excess collateral in Q4 at the end of 2019, and this was we also observed a significant increase in this in 2020 during the beginning of the COVID-19 crisis. The composition in the article, we look at the composition of the collateral in terms of which asset classes is this collateral associated with, and we do a bit of a decomposition exercise, and we find again a pattern which broadly, not quite exactly mirrors the notional split, but it broadly does, in the sense that we see a much larger share for interest rate derivatives, followed by equities, commodities, credit, and currency. In terms of concentration, there's relatively low concentration of collateral, but there is disparity across CCPs. I think there's one CCP where it's more significant, and the article describes that in more detail. And finally, the article concludes with a little bit of analysis, looking at a systemic risk measure of impacts, looking at, in some sense, how the CCPs could absorb losses from central clearing members, if there were a severe market shock. So it presents a little bit of analysis on that and how that systemic risk measure changed over 2019. So that concludes my short run through of the derivatives report, and I'm happy to hand it back to Christian to manage the questions. Thank you.
Thank you very much, Damien. In terms of the questions, I suggest that we first do the will also on there is trading going on. Caroline?
Yes, thanks. I think yeah, I think you got disconnected for a minute, but I think I understand the what will happen now. So yeah, let me try to answer as many questions as possible, and obviously I think we also remain available if you have questions in the future. So really don't hesitate to contact us. The first question that I see in the chat was linked to the way we did the filtering.
Sorry.
Christian?
I think he's having technical problems. So Caroline, you just go ahead. Why don't you?
Okay. Okay, thank you. So yes, the first question was linked to the filtering we did to arrive to look at basically equities and bonds. So what we did, we look at the CFI code. It helps us classify those instruments. The question was also on what type of equity-like instruments are we observing in the report. So using the CFI code, we were able to disentangle between equity, so shares, exchange traded funds, and what we classified as equity-like instruments in this bunch, which represent 5% of the instruments, the equity instruments available for trading. They are depository receipts and certificates. So really answering your question, there's not warrants, no warrants in the instruments that we look at, but they are certificates. All in all, those equity-like instruments make up 2% of the trading volumes. Then we had a question on what is, how do you identify the most relevant markets in terms of the trading venue with the highest turnover? I'm not sure I understand entirely the question, but I think it's linked to the transparency calculation. So for the transparency calculation that you will find on ESMA, on ESMA's website, that's how we calculate the most relevant market by looking at basically the number of volumes on each trading venues. And so we deem as the most relevant market the one with the highest volume. Not sure I answered your question, but again, I'm not sure I understand the question, so don't hesitate to precise it in the chat if you want. Then we had a very interesting comment from AFMI on the liquidity that we observe in our report. I think it's a very interesting debate, and I will be grateful actually to discuss it, but maybe bilaterally, because it will be difficult to compare our methodology now. So I think it's indeed useful for us to be able to discuss further how you do your analysis, and also to share how we did ours, and maybe also to improve our reports in that way. So really grateful for that. Then I guess there was sorry, I think I maybe lost. Yes, I think there was one question on, yes, the figures, do they cover EU entities or one EU and outside entity? My quick answer would be we have a venues way to look at things. So basically we have everything that is happening on EU venues, be it between EU entities or between one EU counterpart market participant and one market participant that can be of another domicile. But then for OTC, that's where we will narrow it down to EU counterparties. So I hope that answers your question, but basically what we just keep in mind that we have this venues analysis, so we enter the data with the venue and not the counterparties, because we don't know who are the counterparties with our databases. And then I don't know if I think we got you back, Christian. I don't know if you want to add something.
Yeah. No, thanks, Caroline, and apologies, seem to be connection problems. And I think the question around the counterparties is maybe more relevant for the derivatives report. So would maybe also ask Damien to answer that question.
Indeed, sorry.
Damien, do you want to briefly comment on that one? So because there, so I don't know, can you still hear me?
Sorry, I was muted. Go on.
Yeah.
Can you just repeat the question? Sorry, thanks, Christian.
So the question around whether basically which type of transactions do we have, only EU versus EU, or also EU with a third country, and basically the answer is on EMIR we have these are transactions we have. What we do not have are transactions between two third country counterparties.
Yeah, that's absolutely right. So essentially, the way EMIR works, putting it simply, is that counterparties based in the EU and the EEA will report to us, and that means they'll report also who the other counterparty is, which means we capture a third country counterparties who have an exposure to an EU counterparty, but we wouldn't have third country to third country exposures. And obviously with Brexit, because 2019 was a year when the UK was still within the EU, so we essentially is unchanged from previous years. But going forward, that will change in terms of data coverage. Christian? I don't know if we've lost Christian again.
Looks like the line has gone stale again. Let me jump in right away. And as we're in any case nearing the end of the conference today, let me just see, as we do not have additional, there is one additional message towards the end. Is from Florian Moritz. I do not know whether you already had a chance, Caroline and Damien, to answer that question. It's is there a way to identify the amount of firms within each market type, active markets? Well, the number of instruments is interesting. It will also be highly relevant to see how the amount of firms, how the amount of firms using equity markets change. Does ISIN do the trick? I guess not, right? That is what Florian is asking. Caroline, maybe briefly?
Yeah, that's an interesting proposal. Actually, we did not that. Yeah, that's something to maybe to think about. Thanks a lot.
And yes, ISIN does not do the trick completely. Let me add to that. This is a more multifaceted problem, this identification thing on which we are working at the moment. So thank you for that question. As I see that there is not an additional one in the chat, let me just make sure that we do not see any hands up of colleagues who want to speak live or have additional comments. This is not the case as far as I can see. Oh, there is Marc Bertout.
Yeah, thanks for that. In fact, I posted a message on the chat, but maybe you've missed it or it was not handed over. Just the question is, in the report, there interestingly a nice list of a league table of individual systematic internalizers. And we know by capturing the usual market data, the SIs are hidden behind the APAs. So is this level of transparency that you disclose in your report going to be regularly available in the future?
Caroline? You're still on mute.
Sorry. Yes, I think for now we intend to keep this analysis and yeah, that this will be in the annual report. Yeah.
So sorry, just if I may just bother you again. What's the source from your point of view? Is that the quarterly report of the RTS 27?
For which report? I'm not sure.
For the systematic internalizers tables, what data source are you using? Is it something that is going every day into your database? Because there are also those you know, those transparency reports for RTS 27.
Maybe we can ask, is Carlos on the line, who is a Chief Data Manager? Carlos, do you know?
Yes, yes. So the reports come, the origin of the reports are regulated in both RTS1, so the RTS relevant to equity and equity-like instruments, including the obligation to report by daily data, aggregate daily data by all these participants. And regarding bonds and other non-equity instruments, the reference, the legal text will be RTS2, non-equity. So not RTS 27 that we are not using for this report.
Does that
Thanks
address your question, Mark?
Yes, absolutely. Thank you very much.
You're
Wonderful.
welcome.
Thank you for asking and giving us a chance to clarify this point. With that, I see no more hands up. Let me, at this stage, just give Caroline and Damien an opportunity. Is there any last item that you want to raise before we close the meeting, or shall we move on with wishing a farewell to our listeners?
Nothing from me, Stefan.
Okay, Caroline also? Very cool. Let me then take the opportunity to thank all the interested market participants, academics, colleagues from the policy sphere who I saw, and journalists who I saw on our list of attendance. Let me thank all of you for attending our today's meeting and for listening to our presentations, also for engaging in the discussion. This was extremely interesting and helpful for us. Thank you very much. Of course, we will be back with more material, analytical and statistical stuff. The next one for us is the publication of the annual statistical report on alternative investors and a trends, risk and vulnerabilities report in February and March next year. So we're looking forward to your comments on that one too. And until then, we wish you all the best. Also for the time running up until Christmas. Thank you very much, and looking forward to seeing and speaking to you again in the future. Thank you.